Good afternoon and welcome to everyone on the webcast, those dialing in via the telephone lines and via LinkedIn. Today we are sharing the Nedbank Group's annual results to 31 December 2022, which we believe demonstrate that Nedbank has done well in what is an increasingly difficult environment, particularly here in South Africa. The agenda of today's presentation, as shown on the right of the slide, will start with me sharing a few thoughts on the operating environment, then reflecting on the progress we have made on our strategic growth drivers, and also providing an update on our recent board and leadership changes, before handing over to Mfundo Nkuhlu, our Chief Operating Officer, who will share in more detail the progress we've made on our technology strategy and how this is increasingly evident in what we call our strategic value unlocks. Mike Davis, our Chief Financial Officer, will follow Mfundo with an analysis of the group's financial performance, and thereafter, as we usually do at year-end, each of our frontline managing executives will cover the financial performance, strategic drivers, and outlook of the respective business clusters. I will then return at the end to close off the presentation with our outlook, including our 2023 short-term guidance, as well as highlight new targets we have set ourselves for both the medium and long term. As usual, some slides are marked booklet slide in the top right-hand corner, and these slides are additional information for investors that we will not speak to directly in the presentation today. So starting with a high-level overview of the key aspects of our performance and results all on one page. The external operating environment in 2022 remained very challenging for us and our clients, both globally and more so here in South Africa, as is evident in the weak GDP growth numbers, severe electricity shortages, higher interest rates, higher levels of inflation, and the muted performance across both equity and bond markets. From a strategy perspective, our delivery remains on track. We continued to see the benefits of digitization, delivered through the substantial completion of what has become known as our Managed Evolution IT Build program, and this is driving continued improvements in client experiences, main bank clients, and household transactional deposit gains, as well as improved efficiencies, all while we continue to lead on ESG matters. Operational metrics are also pleasing, evident in pre-provisioning operating profit growth of 15%, a positive jaws ratio, and a cost-to-income ratio that is still too high, but declined to 56.5%. From a financial point of view, the group delivered a strong set of results across all key metrics, with headline earnings up 20% and ROE increasing to 14%, driven by an 11% growth in revenues and good expense management. At the end of December, and borrowing from the terminology that JP Morgan often uses, we have built a fortress balance sheet, with all key capital, liquidity, and coverage metrics at all-time highs. And off this foundation, the total 2022 dividend increased by 38% to 16.49 rand, the highest dividend in the history of Nedbank. Reflecting at the bottom of the slide on our published targets to the end of 2023, in these results, we have now met our diluted headline earnings per share target and net promoter score targets, both a year earlier than initially planned, and we continue our good momentum towards achieving the 2023 ROE and cost-to-income targets. However, as you will see in my closing slides, beyond 2023, we still have much hard work ahead to achieve our ambitious new medium and long-term targets. Reflecting now on the external operating environment in a little more detail. From a global perspective, the Russian war in Ukraine, supply chain constraints in China, rising inflationary pressures, particularly energy and food prices, and as a result, monetary policy tightening ahead of expectations all impacted on the South African economy. Despite the impact of these global developments, as well as domestic challenges, such as the severe electricity shortages and floods in KwaZulu-Natal, the South African economy has demonstrated relatively high levels of resilience, and South Africa's GDP is expected to have increased by around 2.3% in 2022 as shown in the first graph. Looking at the top right, inflation remained above the top end of the SARB's 3 to 6% target range, but does appear to have peaked, and interest rates in the bottom left graph increased by 325 basis points. As we have said many times before, energy supply remains the key risk facing the South African economy, and the graph on the bottom right starkly illustrates the escalation in this crisis, with the number of days that we have had electricity load shedding increasing in 2022 to 208 in comparison to 75 in 2021. While South Africa's economic potential remains compelling, and I will come back to this later, South Africa is fast reaching a tipping point in a number of key areas. Our failing state-owned monopolies, and in particular those responsible for electricity generation and transmission, transport and logistics, and water, combined with poor crime prevention and prosecution, remain binding constraints on much-needed investment and, as a result, higher levels of economic growth and job creation. The destruction of important infrastructure that is vital for economic growth and fiscal sustainability simply cannot be allowed to continue. This requires urgent and decisive action by government, labour, civil society and business, and Nedbank remains committed to working with all like-minded South Africans to accelerate delivery of the structural reforms in these key areas that are necessary to achieve higher levels of economic growth and job creation, as well as underpin our longer-term fiscal sustainability. The reality of failures of many state-owned monopolies and poor service delivery in key network industries has led to very disappointing outcomes that are making South Africa an increasingly unattractive investment destination and, as a result, limiting economic growth and job creation. This slide highlights the extent of these issues. Notwithstanding massive investment, electricity production is down 16% compared to 10 years ago, leading to increasingly severe electricity shortages or load shedding. A rail transport system where the weight of goods and number of passengers transported by rail have declined by 30% and 97% respectively over the same 10-year period, putting immense pressure on our road infrastructure, contributing to large losses in export earnings and to the fiscus. And water supply being constrained because of poor maintenance and lack of adequate investment, things that are particularly important in a water-scarce region such as ours, as the impact of climate change increases. In addition, high levels of municipal audit outcomes remain unsatisfactory, and insufficient progress has been made in the fight against serious crime and corruption, all evidenced by the data on this slide. This is one of the key reasons for the FATF grey listing of South Africa, being, and I quote, the lack of effective ability to successfully investigate and prosecute cases of corruption and money laundering. And while the grey listing was not unexpected, and pleasingly there were no findings against the financial sector, we are committed to work with all the relevant authorities to ensure we exit this list as quickly as possible, as the economic damage from this will escalate over time. The unfortunate combined outcome of all of these is increased unemployment and a 13% decline in SA GDP per capita in dollar terms since 2012, showing how on average South Africans are becoming even poorer. This simply cannot continue, and more urgent and decisive leadership action is required. The ranking by the World Economic Forum of the top 5 risks they see in South Africa, as shown on this slide, is a stark reminder of the global view on these risks and therefore the extent of the crisis we face in South Africa. Corporate South Africa has the skills, resources, and capabilities to help address many of these issues, but the will of the political and public sector to make meaningful change remains uneven, and actual delivery is poor, and as a result, progress on structural reform is far too slow. Looking at the electricity crisis in a little more detail, We believe that South Africa's path to net zero is, over time, also our path to energy security. And calculations show that on average 7 gigawatts of new renewable energy generation is needed per annum to 2030. While we support the NECOM plan that includes improving Eskom's own electricity generation, procuring new generation, private power generation, and business and rooftop solar solutions, based on our analysis, the timelines are ambitious. However, electricity production will not solve the country's energy crisis unless grid allocation and capacity constraints are also resolved, as we saw in the failure of bid window 6, and this also requires urgent attention. Unfortunately, this crisis cannot be solved in the short term, and even the private energy generation projects of 9 gigawatts that have been registered to date will only start benefiting generation in late 2024 and into 2025. Many investors are also interested in the impact of load shedding on our business. In the booklet slide, we provide more detail, but I would like to highlight the following on the right of this slide. By far, the largest impact for us as a bank is on the decline in economic activity experienced by our clients, which is reflected in our economic unit recently downgrading their 2023 GDP growth forecasts from 1.4% to 0.7%. And there is downside risk to this, as this forecast assumes load shedding at around stage 4 throughout the year, and the experience certainly in the first 2 months of 2023 suggests more persistent levels at around stages 5 and 6. Operationally, the impact on Nedbank and our clients' ability to use our products and services is very limited, on the back of measures that we have taken over the years. But at just under 60 million rand, annual diesel costs are escalating. From a client point of view, on the one hand, we see strong and increasing demand for renewable energy-related finance, which Anel Bosman will expand on later, but also the risk that corporates will become more cautious in other areas of investment until more demonstrable progress is evident on the NECOM plan. From a credit quality point of view, we can see high levels of stress emerging, specifically in the SME segments of the market. However, as I said earlier, notwithstanding these challenges, South Africa's potential as a long-term investment destination remains compelling. As highlighted on this slide, South Africa has abundant natural resources, being a top 10 producer of many scarce minerals as well as agricultural products. We are a very attractive tourist destination. Our financial markets are sophisticated and among the best and most liquid among emerging markets globally, while our banking sector is very well regulated, profitable and strong, evidenced in how well we have navigated both the global financial crisis and the COVID-19 crisis. Lastly, our corporate sector is generally well managed and resilient, with strong balance sheets and low levels of debt, while South Africa remains a key gateway into the rest of Africa, providing both economic connections into the continent and being a large trade partner, with the benefits of the African Continental Free Trade Agreement likely to emerge more strongly over time. Turning now to strategy, and our strategy on one page and a slide investors should be very familiar with. We have, since 2021, been focusing on the 3 strategic value drivers you see here: growth, productivity, and risk and capital management. And we believe that by delivering on these, they will enable us to reach our financial targets, which I will discuss in more detail at the end of the presentation. Underpinning the delivery of these 3 are 5 strategic value unlocks, or more simply, programs of action enabled by our Managed Evolution IT strategy. You can see these towards the bottom of the slide. Mfundo Nkuhlu will cover our progress on these in more detail right after I finish. So let's look now at the progress we've made on the strategic value drivers of growth, productivity, and then risk and capital management. Starting firstly with growth. This graph shows how growth trends across net interest income, non-interest revenue and advances have continued to improve from the COVID-19 pandemic lows. The structural benefits from higher interest rates have been favourable for net interest income, and we forecast continued strong net interest income growth into 2023 as the benefits from interest rate increases run rate even more strongly. Revenue growth was further supported by client-driven activity. CIB recorded 25 primary client wins, BB grew main bank clients by 6%, and Nedbank Africa regions grew their client base by 6%. All digital metrics also continued to grow strongly, with app volumes, the key retail channel, up 34% year-on-year and up by more than 250% since 2019. Insurance income was up 18% and remains a large growth opportunity for us as we work on embedding new digital products and deepening cross-sell across the group. In contrast, weak financial markets negatively impacted assets under management, which was down 7% to 393 billion rand, slightly less than the 9% decline we reported in the first half, while trading income decreased 7%, also slightly less than the 10% decline we reported in the first half. From a productivity point of view, we continue to see the outcomes of our optimisation efforts becoming more evident. Our cost-to-income ratio is high, but reduced to 56.5% on our way to our short, medium and long-term targets of 54%, 52% and 50% respectively. These productivity improvements have in large part been driven by the emerging benefits from rolling out our Managed Evolution IT build that is now at 91% completion and which has enabled increased client use of our more cost-efficient digital channels, as well as ongoing process improvements alongside headcount reduction, mainly through natural attrition, and real estate optimization, amongst others. Our key risk and capital management metrics are evidence of a fortress balance sheet, as I said earlier. Starting at the top left of this slide. Given our strong financial performance and a slight reduction in risk-weighted assets, our CET1 ratio at 14% ended the period well above the 12% top end of our board target range for this metric. Mike Davis will reflect later on this strong capital position as well as our approach to capital optimization and the board-approved share buyback program of up to 5 billion rand over 12 months that we announced today. On the bottom left, liquidity metrics such as the LCR and NSFR are very strong and much higher than pre-crisis levels. On the top right, these robust capital and liquidity outcomes supported a strong final dividend of 866 cents per share, and as a result, the full-year dividend is up 38%, and as I said earlier, a record level for the group. On the bottom right, looking at credit, our credit loss ratio increased to 89 basis points, still within our through-the-cycle target range, while overall impairment coverage remained high at 3.37%, highlighting ongoing prudency in balance sheet provisioning in a difficult economic environment. Lastly, during February, we announced a number of board and Group Exco changes. Starting with the board, as previously announced, Mpho Makwana, our board chairperson, will retire from the board at the conclusion of our AGM in early June this year and will be succeeded by Daniel Maneli, who joins us as an independent non-executive director from May and thereafter as chairperson from June. We are pleased to have attracted someone of Daniel's undoubted skills and experience to the role of Nedbank chairperson. Trevor Adams, our Chief Risk Officer, will retire at the end of March and will be succeeded by Dave Crew-Brown, while Fred Swanepoel, our Chief Information Officer, will retire in June and be succeeded by Ray Naika. These appointments evidence good succession planning and bench strength, and handovers of both portfolios are already well underway. I would like to express our gratitude to both Trevor and Fred, who have played an instrumental part in the success of Nedbank, and we welcome Dave and Ray onto the Group Exco. We will formally thank Mpho at the AGM in June. I will now hand over to Mfundo Nkuklu, our Chief Operating Officer, to share our successes and the progress we have made on our 5 strategic value unlocks.
Thank you, Mike. Good afternoon, everyone. I'm pleased to report that delivery on the group's strategic value unlocks is progressing well and delivering financial benefits, as Mike has noted. It is particularly pleasing that the result is underpinned by strong execution of our strategic priorities and good operational performance. Today, I will cover the group's 5 strategic value unlocks. I will start with an update on the progress we have made on our managed evolution technology strategy, and then move on to each of the strategic value unlocks in more detail. Our managed evolution technology program to build a world-class technology platform is nearing completion and delivering benefits as per plan. The final IT components will be delivered over the next 12 to 18 months, including the refactoring of core banking, such as deposit and transactional products. As shown in the graph on the left, to date we have completed 91% of our IT cash flow spend. And if you look to the right, we have realized 58% of the run rate benefits. Importantly for us, it means the risk of material overspend is behind us, as IT cash flow spend peaked in 2017, and we now see a more normalized spend of around 16 billion rand going forward, as shown in the booklet slides. In addition, the IT asset on our balance sheet has also peaked and reduced from 8.9 billion rand in 2021 to 8.3 billion rand in 2022. This implies a slowing of the rate of increase in the depreciation of the IT asset through the income statement. The following slide highlights the multiple benefits that have been derived from our world-class technology platform and the enhanced digital innovation processes that we have put in place over the past few years. With regard to benefits for our clients, starting on the left, client onboarding is now mostly done digitally via our Eclipse platform for 99% of our retail clients. More than 75% of our juristic clients currently use the Nedbank Business Hub, and we aim to reach almost 100% by the end of 2023. Digital services have also been automated, and today more than 170 retail client services and more than 280 juristic services are available digitally on apps and electronic platforms, enabling our clients to self-service. From a product sales perspective, 53% of retail sales are done digitally, up from 12% in 2019. Client experiences continue to improve, with Nedbank recently ranked the #1 SA bank on Net Promoter Score, which Ciko will talk to later. Benefits for Nedbank are shown on the right. As systems became more simplified and we adopted agile work practices, the number of IT changes put into production increased by 63%. At the same time, we are reporting some of the best systems availability in the SA peer group, enabled by IT system downtime that decreased by 75%, resulting in 99.3% uptime. From an operational efficiency perspective, we have adopted digital practices and since 2019 managed to unlock a 24% reduction in floor space and an 11% decrease in headcount, mainly through natural attrition. We have also seen revenue benefits as evident in an increase in retail cross-sell ratios, while the new digital capabilities also allow us to provide value-added services which grew by 129%. The most noteworthy point for me has to be the 3.5 billion rand derived from our target operating model benefits to date. Expanding further on the highlights, digital uptake and usage continue to accelerate, as evident in the multiple metrics shown on this slide. Digitally active retail clients increased further to 68% of active clients, while the sales of products through our digital channels increased as noted before. Digital transactional volumes and values have increased by 76% and 40% respectively since 2019. And the trend towards usage of Nedbank banking apps is even more pronounced, with a 142% increase in active app users and an almost 2.5 times increase in volumes and values transacted. The efficiency benefits from the managed evolution IT investments and digitization are also evident in our target operating model program. TOM 2.0, which was launched in 2021, is aimed at optimizing the shape of our physical infrastructure and organizational design in a more digital world, including projects Phoenix and Imagine that Ciko will cover later, and optimizing our shared services functions across the group, all as a direct result of the digital benefits from managed evolution. In 2022, TOM 2.0 realized cumulative benefits of 1.5 billion rand, well on our way to a target of 2.5 billion rand by the end of 2023. The benefits of our TOM program are evident in improvements in key operational metrics, as we show on the right-hand side of the slide. As more products and processes are digitized and customer behavior changes, we have been able to reduce headcount over the past few years, while commercial real estate square meterage is also reducing. Turning to our focus on growing in attractive areas for value creation, or strategic portfolio Tilt 2.0, the outcomes have been mixed in 2022. Our overall aim is to target profitable market share gains over time and increase cross-sell, while being prudent in the prevailing difficult credit environment. The growth opportunities in infrastructure and SDG-related financing, particularly in wholesale lending, remain, and we're pleased with the increase in advances growth rates in our CIB business in the second half of last year. We have, however, been more selective in areas where we have strong market share, such as commercial property finance and vehicle finance, and therefore comfortable with the small declines in market share. Given the increasing risk in the environment, we have been more prudent in granting personal loans. As a result, market share has decreased slightly, although we still aim to grow share over time. We increased market share in retail overdrafts, home loans, household transactional deposits, and non-transactional deposits as management actions start to yield results. Through our fifth and final strategic value unlock, we focus on creating positive impacts by delivering on our purpose of using our financial expertise to do good for all our stakeholders. Our contribution to social matters, as viewed through the lens of the Sustainable Development Goals, is one of the measures we track. In 2022, we provided SDG-related finance to the value of 123 billion rand as exposures on our balance sheet. This represents 14% of the group's gross loans and advances. By 2025, we aim to increase this to around 20% through the support of projects and initiatives of more than 150 billion rand in areas of sustainable development financing. On the right, we highlight some of the impact we have made, including the 26 billion rand in support of farmers, 3.5 billion rand towards new affordable housing loans, supporting 5,500 homes, and the provision of 500 million rand funding for water. In the middle row, we highlight our increased lending to SMEs to 21 billion rand, as well as 27 billion rand of renewable energy exposures and 12 billion rand in sustainable finance in our CIB business. Turning to the highlights of our ESG achievements in 2022. In recognition of good ESG practices and outcomes, our MSCI ESG rating improved from AA to AAA, ranking Nedbank among the top 5% of global banks, an achievement we are most proud of. From a human capital perspective, we rank high on diversity indices as both our diversity and gender metrics continued to improve, and our employee best place to work Net Promoter Score increased to 22, a multi-year high. We have also retained our level 1 BBEE status for 5 years in a row and provided cumulatively more than 7,000 first-time job opportunities to youth employment service participants. We remain one of the largest corporate participants and the largest bank on the YES program. From a shareholder perspective, we listed on A2X Exchange in 2022, offering investors choice, and as a result, the Nedbank share has regularly ranked as a top 10 most traded stock. In October, we announced the next step in our mandatory audit firm rotation journey with the appointment of KPMG to replace Deloitte, effective from 1st January 2024. In conclusion, Mike discussed the challenging macro and operating environment that we have encountered. From my slides, it should be clear that in contrast, we have made great progress on our own strategic and operational delivery. At the same time, we have also created value for our stakeholders and play a key role in the countries in which we operate. I spoke about the positive outcomes on employee matters, and this shows the significant investment we have made in employee development, retention, and wellness to be an employer of choice at a time when there are material skills shortages and the fight for talent has escalated. We are proud of our leading position on the YES program to help address youth unemployment. I've demonstrated the value we created for our clients with higher Net Promoter Score and 341 billion rand in new loan payouts. And for our shareholders, these results, the declaration of a record dividend, and 2 years of share price appreciation ahead of the bank's index have been value accretive. From a regulatory perspective, we continue to work with the Prudential Authority of the South African Reserve Bank and the Financial Sector Conduct Authority to keep the financial system sound and healthy. And through structures such as the Banking Association of South Africa, we engage constructively on industry matters. And lastly, I have covered in my slides the value we are creating as a result of the financing of infrastructure, renewable energy, and sustainable development finance, to name a few. We are also active members of organizations like Business Leadership South Africa, working to improve economic environment for business and society in our country. It is therefore pleasing that in addition to our strong earnings growth and fortress balance sheet, we have also created value for all our stakeholders, and in so doing, for the communities and countries we operate in. Thank you, and I will now hand over to Mike Davis, our CFO, to take us through the details of this strong financial performance.
Thank you, Mfundu, and good afternoon, everyone. I'm pleased to report strong revenue growth experienced in 2022 has supported a 20% increase in the group's headline earnings to 14 billion rand, a higher ROE at 14%, and a CET1 ratio that reached an all-time high of 14%. I will unpack the underlying drivers of this trio of 14s in the next few slides. The strong financial performance of the group needs to be considered in the context of both the operating environment, as Mike discussed earlier, and the progress made on delivering our strategy, as Mfundu has just demonstrated. While we benefited from rising interest rates as a result of endowment income, the balance of the macroeconomic drivers have created headwinds for us and our clients. Delivering on our strategy, on the other hand, has been supportive of our financial performance, driving both revenue growth and cost optimization, and their impact will continue into 2023 and beyond. Looking at the key drivers of value creation in Nedbank, 2022 was a good year for us and our shareholders. Net asset value per share increased by 5% to just over 215 Rand per share, implying a price-to-book ratio of around 1 times at 31 December. The group's ROE improved from 12.5% to 14%, but is still below our estimated cost of equity of just under 15%. And as Mike mentioned earlier, we declared a record high dividend. All of the group's profitability metrics have improved, as seen in very strong headline earnings, DHEPS and EPS growth, and these double-digit growths were in line with the trading statement we released last week. Importantly, earnings metrics are now above the pre-crisis levels, with DHEPS above 2019 levels a year earlier than we initially expected. Our balance sheet remained extremely strong, with higher liquidity and capital positions well above regulatory requirements and our own internal targets. Our credit loss ratio increased to 89 basis points, which was in line with the guidance we provided, and our total coverage increased further to 3.37%, another multi-year high. Turning to our usual waterfall graph, where we show the key drivers of the 20% headline earnings increase. On the revenue side, NII increased by 12%, NIR by 10%, and associate income also by 10%, including a 175 million Rand estimate of the anticipated impact of our share of the Ghana debt restructuring on ETI. Impairments increased by 13%, and expenses were well managed, growing at 8%. Our effective tax rate declined to around 22%, including the effect of profits taxed in different jurisdictions. Turning to the balance sheet, gross banking advances increased by 7%. At a cluster level, CIB banking advances growth accelerated in the second half of the year to 8% on the back of stronger credit demand and the execution of deals in our pipeline. In RBB, the growth momentum continued, with strong growth seen in our SME and commercial banking segments, as well as in secured lending products. Advances growth in wealth and NAR was muted. On the opposing side of the balance sheet, deposits also increased by 7%, with underlying behavioral shifts clearly evident as clients shifted from savings and cash management deposits to longer tenor term and fixed deposits to take advantage of the rising interest rate environment. Current accounts within CASA showed solid growth, supporting our transactional household deposit market share gains. Pleasingly, as shown on the right, the wholesale funding contribution to the bank's funding mix continues to decline, now at 31.5%, while household funding increased to more than 19%. Turning to the income statement, NII increased by 12%, driven by a 20 basis point increase in the net interest margin to 393 basis points, with our Q4 NIM now above 4%. Endowment benefited from higher interest rates, added a further 23 basis points, while liability mix and pricing added a further 8 basis points. These increases were partially offset by asset mix changes as lower margin wholesale advances grew at a faster pace in the second half, and as we slowed growth in higher margin unsecured lending during the period. The reclassification of the foreign loan portfolio previously held in the trading book diluted NIM by 7 basis points, as we discussed at the half year. Importantly for Nedbank, in a rising interest rate cycle, we are positively positioned as NII benefits by approximately 1.6 billion Rand for each 100 basis point interest rate increase over a 12-month period, which is clearly evident in the widening quarterly NIM numbers shown above the graph. This benefit will continue into 2023. Turning to NIR, growth increased by 10%. The key drivers include commission and fees increased by 7%, primarily as clients' transactional activity recovers, as main bank client growth accelerates, and as we increased levels of cross-sell. Rico will unpack these later. Trading income decreased by 7% given unfavorable debt and interest rate markets in South Africa. Insurance income increased by 18%, driven by lower claims in our life portfolio, partially offset by an increase in non-life claims and the impact of the CAT event in half one as a result of the flooding in KwaZulu-Natal. Equity revaluations increased 25%, driven by higher revaluations in our commercial property portfolio as the sector recovers post-COVID. Anel and Arlanda will provide more detail on these later. Lastly, the fair value losses in 2021 did not repeat as we had expected. During the period, we reclassified the net monetary loss into NIR as an offset against the FX gains as a result of hyperinflationary conditions in Zimbabwe. The FX gains realized on hard currency assets acts as a natural hedge against the net monetary loss. Our impairment charge increased by 13% to 7.4 billion rand, driven by the 7% growth in banking advances, the higher impairments in interest rate-sensitive products such as home loans and vehicle finance, as well as a few large corporate clients that migrated to Stage 3. These increases were partially offset by overlay releases previously held against anticipated defaults. During the year, almost 2 billion rand of overlays were catered for in model, with 1.3 billion of new overlays raised through the income statement, offset by 900 million of existing overlays that were released through the income statement. This resulted in total overlays at the end of the period declining to 1.4 billion rand. No COVID-19 related overlays now remain within our portfolio. From a credit loss ratio or cost of risk perspective, our group credit loss ratio increased to 89 basis points within our through-the-cycle target range of 60 to 100 basis points, and now in the middle of the guidance we provided. CRB's credit loss ratio was well within its through-the-cycle target range of 15 to 45 basis points, notwithstanding us providing for a few specific counters that have moved into business rescue. RBB's credit loss ratio increased to 161 basis points, also within its 120 to 175 basis point through-the-cycle target range, mainly as a result of the normalization of the home loans credit loss ratio and the impact of a more difficult environment on vehicle finance. Wealth recorded recoveries and NAR returned to within its through-the-cycle target range. Our balance sheet ECL increased to 27.9 billion rand, driven by the 7.4 billion rand impairment charge, as well as the impact of higher write-offs and post-write-off recoveries, both at multi-year highs. Our total ECL coverage increased to 3.37%. Unpacking the ECL coverage in more detail, Stage 1 loans grew 7%, in line with the growth in gross loans and advances, while Stage 1 coverage declined as a result of lower coverage on new loans. Stage 2 loans declined by 21%, with coverage increasing to 7%, as Stage 2 loans migrated into Stage 1 or Stage 3. Overall, Stage 1 and Stage 2 coverage remains well above pre-COVID levels of 0.48% and 5.3% respectively. Stage 3 loans increased by 31%, as a few large specific CRB clients migrated from Stage 2 into Stage 3, and because they had high levels of collateral, Stage 3 coverage declined slightly to 34.3%. Turning our focus to costs, expenses increased by 8%, primarily impacted by an increase in incentives and the post-COVID normalization of discretionary spend. Excluding incentives and other staff costs, expenses increased by 5%. Salaries and wages increased by 4%, reflecting the impacts of an average annual salary increase of 4.6% and a decline in headcount of 3%, largely through natural attrition. Incentives increased by 23%, aligned to the improved profitability, and other staff costs increased as a result of lower returns on employee benefit assets and as we expense more IT staff costs instead of capitalizing for smaller projects. Computer processing costs increased by just 3%, and importantly, the rate of growth in the amortization charge is slowing as our managed evolution journey matures and we leverage cloud-based solutions. Marketing and travel costs increased as business activity normalized. This was offset to some extent as we continue to see optimization benefits coming through in areas like accommodation due to hybrid ways of work. With respect to capital, our CET1 ratio increased to an all-time high of 14%, driven by higher levels of profitability and slightly lower risk-weighted assets, partially offset by the payment of dividends during the period. The RWA decrease, as we show on the booklet slide, was driven primarily by lower counterparty credit risk and lower market risk, while credit risk increased. Our 2022 interim and final dividends were both declared at the bottom end of the board-approved dividend cover range of 1.75 to 2.25 times, or at the top end of our payout ratio. Given the group's strong capital adequacy at 31 December, reflected in the average 11.8 billion rand excess capital position, the board has reviewed the level of the structural capital surplus as well as the expected future capital requirements of the group, including strategic initiatives, operational requirements, and to support strong levels of client growth. This culminated in the board approving a share repurchase program of up to 5 billion rand to be executed over the next 12 months, subject to all legal and regulatory approvals and requirements being met. The proposed repurchase program is expected to be accretive to DHEPS, optimize capital levels and associated returns on equity, and in so doing, deliver value to our shareholders. Lastly, before I hand over to the managing execs, a quick overview from me on our cluster performance on a page. The group's headline earnings growth was driven by strong performances across all our business clusters, as shown on the left of the slide, with CIB, RBB, and Wealth reporting ROEs above the group's cost of equity. Nedbank Africa Region's ROE improved, but was adversely impacted by estimated impact of the Ghanaian debt restructures on ETI. Excluding this event, ROE would have been above the group's cost of equity. With that, thank you, and I will now hand over to Anal, who is dialing in from her boardroom at 135 Rivonia Road.
Thank you, Mike, and good afternoon. 2022 was a challenging year, characterized by a global inflationary backdrop and geopolitical uncertainty, coupled with the local energy crisis and the events like the flooding in KwaZulu-Natal. Despite this, CIB delivered good results, focusing on our purpose, partnering with our clients, and executing our strategy. Headline earnings increased by 14%, driven by solid revenue growth and prudent risk management. ROE increased to 17.7%. Net interest income grew by 10% to 8.8 billion as the net interest margin increased by 7 basis points, benefiting from deposit margins and endowment, despite transfers from the trading book narrowing the margin by 13 basis points. Non-interest revenue is up by 5%, supported by a 13% growth in commission and fees and a strong performance in the equity portfolio, up 38%. Commission and fees income reflected good activity levels in investment banking on new and existing transactions. The increase in private equity was predominantly in property partners. Trading income declined by 9%, partially offsetting these gains. The strong performance in foreign exchange trading was dampened by debt securities, particularly in interest rate derivatives, and the impact of the excess liquidity driven by the SARB monetary policy implementation framework lowered our margins. Notwithstanding the increase in expenses, we maintained a market-leading efficiency ratio of 44.6%. Impairments decreased by 43%, resulting in a CLR of 22 basis points. The impairment decrease was driven by the curing and migration of various exposures in Stage 2 and Stage 3 loans, and the overlays previously held for this potential risk migration now incorporated in the models. Focus on risk management and the raising of adequate impairments on Stage 3 exposures reduced the total risk coverage ratio to 1.29% from 1.35%. I will touch on the high-risk sectors in the next slide. Optimizing our existing balance sheet is key to improving our returns. We deliberately direct the balance sheet towards value accretive, long-term client relationships. Economic capital usage and risk-weighted assets declined by 1% and 7% respectively. Counterparty credit risk decreased due to methodology refinement and lower derivative exposure. Market risk capital was also lower. Banking advances accelerated in the second half of 2022, with investment banking increasing by 8%, driven by the mining and resources, as well as leverage and diversified businesses. Transactional services grew by 34%, specifically towards the end of the year, as demand for short-term credit increased. Africa grew 22% across CIB. Banking advances also benefited from placements of excess liquidity and changes in accounting treatment of certain portfolios in anticipation of the fundamental review of the trading book. The high-risk sectors improved over the year. We have seen an absolute reduction in the exposure to state-owned entities and municipalities, as some highly stressed and defaulted exposures repaid. From a balance sheet extension perspective, we remain cautious on both these sectors and continue to focus on performing or systemically important entities. We have reduced our unguaranteed exposures to defaulted construction clients. Demand for used aircraft has increased, and the higher activity may further reduce Stage 3 exposures during 2023. The risk migration impact of load shedding is very much client-specific and only experienced by some. Clients are reducing their reliance on the electricity grid where possible, and any load shedding impairments have not been material. With the recent events in Ghana, it is important to highlight that CIB exposures in this country are to key strategic infrastructure projects and commodities that generate foreign currency, are well secured and with external insurance. The property finance business continues to perform well despite the challenging market conditions, mirroring the South African economy. Our portfolio is collateralized by a high quality and well-diversified security pool, and overall gearing remains low with a portfolio LTV of 53%. ROEs are at 6 million on the performing book, low, especially when considered against its size at 161 billion. The CLR for the year was 28 basis points, an increase from the first to the second half, but was below the 2021 figure of 30 basis points. The CLR was driven by large single-name exposures rather than general stress in the portfolio. We incorporated overlays into the models at the half year. As we saw risk emerge, clients migrate to Stage 3 and the remaining portfolio re-rated. Overall, our risk remains well managed and the performance of the business over the last few years reflects this sentiment. CIB, as a purpose-led organization, is focused on creating positive impacts. Our innovative approach to sustainable fundraising has assisted in significantly growing this funding, and we raised an additional 11 billion rand in the foreign-denominated sustainable loans in 2022. We've also grown our sustainable finance lending book with credit facilities at 11.7 billion, up from 1.2 billion last year. Our early support for government's energy program established us as a market-leading renewable energy business, and we will continue to support this program. In addition, private power generation continues to expand rapidly, with numerous projects moving towards financial close. In 2022, we closed the first wheeling deals in South Africa, both being solar PV projects. We are mandated on projects totaling just under 1 gigawatt. In addition, we see a strong drive by our clients to implement wheeled or self-generation projects, supporting the continued growth of our energy transition financing. We remain committed to supporting and enabling sustainable, positive impacts. Building on our history of climate and environmental leadership, Nedbank released its energy policy in 2021, including a commitment to have zero upstream fossil fuels exposure by 2045. The policy recognizes the need for a zero-carbon energy system by 2050 and, importantly, an orderly exit from fossil fuel financing well before then. On behalf of Nedbank, CIB is working on the fossil fuel and power generation glide paths, and we intend to release these in our 2023 reporting. We are piloting the glide paths internally this year, integrating the tool into our business, credit, and risk processes. In line with our energy policy, our reduction targets will initially focus on the emissions related to our lending in the upstream fossil fuel and power generation sectors. Our strategic levers unlock and enable growth in a deeply constrained operating environment. Clients remain central to our strategy. We adopted a focused sector approach in 2019 and will continue to leverage this to deliver impactful client value. While the CIB market remains relationship-driven, we recognize that clients expect responsive digital experiences. This is our warm digital approach. Since launching our integrated business platform, NBH, we have continuously added new client functionality while maintaining a rapid pace of migration. Growing our transactional business ties in closely with our digital approach as we create the building blocks required to improve client experience. Our portfolio optimization contributed to our ROE recovery path and will continue to focus on identifying the right clients and products in the right sectors. We focus on accelerated growth to position our business to expand in a challenging operating climate. Equally important is walking the path to sustainability with our clients by providing the required financial and advisory solutions. Our people are the key source of capability and competitiveness, and we have made significant progress on our diversity, equity, and inclusion journey. We continue to invest in our people to compete effectively for talent. Turning to outlook, our key priority remains to better serve our clients through insights and solutions and to enhance revenue synergies across the business. We drive NIR growth through transactional banking, trading and advisory, and leverage our diversified business portfolio. We emphasize proactive risk management and focus on resolution in stressed sectors. We have a robust pipeline across all sectors, notably energy, telcos, and related infrastructure. We expect strong growth in the energy business as the renewable programs delayed into 2023 and various commercial and industrial projects close. We will continue to focus on sustainable development finance activities, where we play a crucial role in leading, structuring, and coordinating these transactions. Though the South African growth outlook remains challenging, we remain confident to deliver growth through leadership in various sectors, delivering great digital customer experiences, and focusing on enhancing our returns. Thank you. I will now hand over to you, Rico.
Thank you, Anel, and good afternoon, everyone. 2022 was a year of continued commitment to growth for RBB in a challenging environment, punctuated by material financial pressures and strongly emerging competitive headwinds impacting both individuals and SMEs. Retail and business banking continues on its path to post-pandemic recovery, with HE for the year increasing by 12% to 5.1 billion rands, with ROE increasing to 16%, above the group's cost of equity. The main drivers of the growth in headline earnings were an 11% increase in revenue and expense growth kept at only 5%. The positive contribution to headline earnings was offset, however, to an extent, by a 28% increase in the impairments charge. Half of this increase in the charge was due to the low base from 2021, a period in which releases of COVID-related conservatism took place. The balance on the growth in the charge is ascribable to the deteriorating macro environment in evidence throughout 2022. Growth in revenue was driven largely by strong NIR, as all sectors of the economy opened in earnest, as well as strong NII growth, which benefited from an improved NIM due in part to increased endowment revenue. The expense increase, kept at only 5%, was driven by judicious management of discretionary spend and ongoing optimization of operations through Project Phoenix, Project Imagine, and other Target Operating Model 2 initiatives. Turning now to segment franchises. The commercial banking and RRB segments delivered strong growth, with headline earnings increasing by 29% and 42% respectively. Consumer banking headline earnings decreased by 8% as the 22% higher impairment charges offset the pleasing revenue growth. Commercial banking increased its market share in the mid-corporate segment to 24% and saw an improvement in the status of single bank Nedbank clients from 27% in 2020 to 36% in 2022. Commercial banking also continued its positive momentum in its digital journey, with Nedbank Business Hub now achieving critical scale. RRB maintained market share across both the affluent as well as SME segments and continues to outperform, with good growth in clients stemming from a highly competitive offering. Consumer banking achieved strong pre-provisioning profit growth of 11%. This off gains in main bank clients, improved cross-sell, and good growth in transactional activity. Client satisfaction is seen as an increasingly strong differentiator for Nedbank. We were therefore very pleased with the outcome of the recent Kantar NPS survey amongst consumers that ranked Nedbank number 1 amongst SA banks on Net Promoter Scores, up from our number 2 position in the 2021 Consulta survey. We shall continue to focus strong efforts in investing in our people and our service excellence program to continuously seek to improve the experience clients have with us as a bank. In addition, our social media net sentiment score also improved, and in 2022, it ranked number 1 amongst SA banks from a number 2 position in 2021. Other achievements in 2022 that support our leadership include a number 1 ranking on brand sentiment and number 1 amongst large banks in the Ask Africa Orange Index, as well as high NPS scores on our digital channels and in our new Imagine branches. These graphs and outcomes demonstrate how we have consistently improved our client satisfaction matrix over time and are differentiating ourselves in a very competitive environment. Client satisfaction outcomes, we believe, are a key driver in client growth and improved cross-sell. The number of retail main bank clients was up 6% to 3.2 million. This increase, along with generally increased transactional activity, recovery in card spend, strong growth in value-added selling products, as well as the digitization of our client base, have all driven the NIR recovery this year. We also continue to scale several key growth vector initiatives to supplement our value proposition and to support sustainable growth in NIR. All segments grew their main bank clients, including the youth segment that registered growth for the first time since 2019. Retail cross-sell is now at 1.94, up from 1.71 in 2019, driven by several purposeful strategies, including Core Plus, as well as the use of artificial intelligence to enable next best action recommendations to clients. A key highlight for RBB in 2022 was the 23% increase in the number of Active Money app users, up to over 2 million. In addition to our traditional digital projects and solutions, we have also been innovating in the platform or ecosystem space in the form of ongoing disruptive market activities, this being our second strategic value unlock. Our ecosystem play is underpinned by Evo. Our Evo Super app has signed up more than 2 million users since its launch in 2020, with active members up almost 5 times. Evo Auto, which we launched in 2021, now hosts over 200 MFC accredited dealerships with more than 8,000 vehicles available on the platform. During the year, we launched Evo B2B Marketplace, making it easy for business buyers and sellers to connect anywhere, anytime on the platform. And we continue to build our partnership network, with our newest being Apple, Dell, as well as Uber Direct. The number of businesses that have registered and are offering their products and services on this e-commerce platform was up 15% year on year to over 20,000. From an operational perspective, Evo has access to over 12,000 drivers in its delivery fleet nationwide as product orders continue to grow exponentially, as seen in a 7-fold increase in gross merchandise value. Through our two target operating model aligned projects, Project Phoenix and Project Imagine, we are shifting our RBB organizational structure so that it is more client-centered and optimizing our branch infrastructure to deliver great client experiences, to enhance sales as well as improve productivity. Our physical footprint shows both the increased drive towards client self-service as well as the diverse South African consumer base that still appreciates face-to-face assistance. In response to shifts in client behavior and preferences that were fast-tracked by COVID-19, we continued to optimize our branch footprint whilst also investing in more mobile and self-service channels. The transition of the frontline business to an agile operating model is strongly underway, and the adoption of these practices, as well as values, have positively impacted frontline sales force productivity. We have achieved actual floor space reduction of nearly 84,000 square meters since 2014. For our newly modeled branches, we have seen an uplift in NIR per square meter. Significant progress also has been made in enhancing functionality across self-service and online channels, providing our clients with much improved convenience. Turning now to credit quality. In home loans, higher interest rates, rising unemployment, and escalating inflation resulted in an overall decline in market application volumes. To combat this, we launched a first-time home buyer CVP. Credit risk appetite and quality of returns remain consistent through the cycle while supporting market share growth aspirations. In MFC, the increase in the credit loss ratio was driven by the deteriorating macro environment and the cumulative impact of interest rate hikes. MFC still remains a dominant player in the vehicle finance market, with market share north of 35%. We continue to work with our dealer partners to gain momentum in growing their reach and efficacy while providing a superior client experience. In personal loans, the credit loss ratio is high. However, there is evidence of a reduction trend, which was achieved through proactive credit risk management as well as debit check operational improvements. Growth is expected to remain subdued in the short term, but is anticipated to improve as macroeconomic conditions recover and new digital solutions are commercialized. In card, the reduction in credit loss ratio was driven off the back of improved risk and collection processes. We continue to focus on book growth through targeted sales and improving customer experiences through the digital channels. Overall, we continue to be pleased with the early evidence in market share turnaround in home loans. We, however, remain wary of the credit loss pressures we continue to see impacting, in particular, MFC. Lastly, we have developed leading client innovations, including Evo, which I've spoken about before. Our VES offering includes digitally enabled lotto, as well as cardless cash out and money transfer on the app. On the insurance side, we are focusing on life, funeral, as well as personal lines. The manufacturing CVP in commercial banking is aimed at improving clients' administrative efficiencies through e-commerce and digitally based self-service solutioning. We have also introduced a solar energy finance offering that will assist our clients, both individual and SMEs, to secure financing for the capital outlay. And we look forward to working with National Treasury on the bounce back scheme to further accelerate this initiative. Through our focus on the township economy, we successfully provided relevant solutions to 12 mega townships in 2022. These growth vectors unlock alternative revenue generation opportunities and help pave the future for the bank. Turning to prospects into 2023, we expect RBB to continue showing performance resilience with a solid post-COVID-19 recovery amidst an expected toughening macro environment. Rising levels of household debt, inflation-fueled prices of basic goods and services, persistent unemployment levels, as well as the adverse effects of load shedding, are all unfortunately expected to persist in 2023 and make it tougher to operate. We do, however, expect continued momentum in advances, with margins continuing to benefit from the higher interest rates. The credit loss ratio is expected to remain within the top half of our through the cycle target range due to this tough macro environment. We aim to grow NIR by diversifying our revenue base and scaling key growth vector strategy, whilst we continue to optimize expenses and deliver positive jaws. Our client-centered growth strategy, as well as execution plans, will also help us achieve these aspirations. Our long-term focus continues to be to reduce the cost-to-income ratio and increase return on equity. Thank you, and I now hand over to my colleague, Ailanda Ruggiero.
Thank you, Tico, and good afternoon. Nedbank Wealth has shown a strong financial recovery with headline earnings of 1.1 billion rand, up 18%. This performance was driven mainly by an increase in revenue, net credit impairment releases, and well-managed expenses. ROE increased to 26.1%, remaining above the group's cost of equity, with both headline earnings and ROE pleasingly ahead of pre-COVID-19 levels. NII increased by 43% to 1.2 billion rand, driven by a widening of NIM from 1.44 to 2.09% due to higher interest rates in SA, the US, EU, and the UK. NIR decreased by 3% to 3.7 billion rand due to revenue lost from the sale of the international Nedbank Group Trust business. In accordance with the group's accounting policies, the profit of 177 million rand from the sale was excluded from headline earnings and reported under other comprehensive income. NIR was further impacted by negative local and international market performance, impacting asset management fees, advice fees in wealth management, and shareholder returns in insurance. Higher non-life claims due to the KZN CAT event also impacted NIR, which was partially offset by reduced life claims. Turning to insurance. Despite lower investment returns and an increase in non-life claims, insurance delivered a resilient financial performance with headline earnings of 499 million rand. Pleasingly, life claims volumes returned to pre-COVID levels. Nedbank Insurance has made good progress in diversifying and digitizing client solutions and distribution channels. The expanded suite of MyCover solution continues to see growth in sales due to channel expansion and increased awareness in the market. The business has also enhanced its quoting, fulfillment, and claims functionality with 10 product offerings across 6 digital channels. Insurance offers a massive growth opportunity for Nedbank and will continue to focus efforts on collaborating with partners across the group to increase penetration while providing a holistic proposition for clients. Moving on to asset management. Asset management continued to experience pressure on fees and was significantly impacted by negative local and international market performance, with headline earnings declining 7% to 351 million rand. This was due to a decrease in NIR as a result of lower AUM, which declined by 7% to 393 billion rand, driven by negative market performance and net outflows, more particularly in the low-margin cash portfolio. Nedbank Group Investments is ranked 6th largest in total AUM locally and 3rd largest internationally, with a market share of 7% and 12% respectively. Turning to wealth management. Wealth management delivered exceptional financial results, with headline earnings increasing by more than 100% to 281 million rand, driven mainly by an increase in NII and net credit impairment releases. Total average deposits remained largely steady, with average deposit balances in wealth management South Africa growing by 7% as clients favoured on-balance sheet investments in the rising interest rate environment. In Wealth Management International, average deposit balances reported in rands were impacted by exchange rates. However, in GBP terms remained steady. Average loans and advances decreased marginally as high net worth clients, both locally and internationally, opted to pay down debt in the higher interest rate cycle. And finally, looking to the outlook, our 2023 performance will be impacted by higher NII and the continued expansion of NIM due to an increase in interest rates both locally and internationally. The credit loss ratio is expected to increase post net recoveries in 2022, but will remain below the through the cycle target range. NIR is likely to increase due to growth in the MyCover portfolio in insurance, normalized life and non-life claims trends, increased cross-sell opportunities through greater penetration into the group, and AUM growth as a result of net inflows. We expect an increase in expenses due to investment in strategic growth opportunities and optimization through automation. The new IFRS 17 accounting standards for insurance contracts came into effect 1 January 2023. This transition is not expected to have a material impact on the Nedbank Insurance legal entity or group reserves. We do, however, anticipate an improvement in the wealth cost-to-income ratio as a result of IFRS 17 recognizing expenses related to insurance products in NIR. Lastly, from a medium and long-term outlook perspective, we expect to maintain a strong ROE of greater or equal to 10% above the group's cost of equity and a reduced cost-to-income ratio of less than or equal to 67%. Thank you, and I now hand over to Terence.
Thank you, Iolanda, and good afternoon, everyone. I'm pleased to report an overall improved performance from the Nedbank Africa Regions business, with headline earnings up 64% to 975 million rands and an ROE of 13.8%. However, although positive, our returns are short of our ambition to achieve greater returns over time. If we take a closer look at our segmental performance that make up the 975 million rands of HE, which is on the right-hand side of this slide, our SADC operations, which we manage and own, achieved an HE of 365 million rands, a significant improvement on the 71 million rands from the prior year, up more than 100%. This generated returns of 5.9%, and we are working tirelessly on improving the quality of earnings and growing this ROE. The main drivers of the performance was an increase in revenue, with NII up 15% and NIR up 23% respectively. The increase in NII was mainly due to improved margins from higher interest rates and NIR that was driven mainly by unrealized FX gains in US dollar-denominated capital in Zimbabwe and increased transaction volumes. This was offset by the net monetary loss in the same subsidiary. Our impairments increased 31%, driven by ECL model reviews incorporating the high interest rate and inflation cycle. Turning to our ETI associate investment, ETI continues to deliver strong performance with HE of 610 million rands and attributable associate income of 779 million rands, up by 17% and 14% respectively. And this includes the 175 million rands estimated impact of the Ghanaian sovereign debt restructure, which we will continue to monitor. What is pleasing is that the EcoBank Nigeria performance has improved, although still suboptimal, and as a shareholder, we will continue to contribute towards resolving the challenges in that key market. Taking a closer look at our SADC operations, our focus across our operations remains to deliver on our Pan-African digital growth strategy as we look to build scale and be more efficient. In 2022, we pushed further in becoming a more digitized business and grew clients by 7% to over 360,000. Our digitally active clients now make up 57% of the base, up from 54% in 2021. Our apps across the regions continue to be the channel of choice, with app users increasing 29% year on year. This all comes on the back of some exciting digital CVPs and solutions landed across the region, which include enablement of clients to apply for various insurance products and fixed deposits via our app and online banking. Our business clients are now able to perform bulk send money and payments to clients with mobile numbers. And loan applications are now enabled via our digital channels in Mozambique. Overall, good progress was made in achieving our digital growth ambitions, and going forward, we will migrate the subsidiaries onto the group's technology stack and deliver more product to the regions. Now, taking a closer look at our ETI investment. On the graph on the top left of the slide, associate income relating to the group's 21% shareholding and based on their 9-month results increased by 14%. This includes the 175 million estimated impact of the Ghanaian sovereign debt restructure, and excluding this, associate income would have been up 39%. On the graph below, the carrying value was 1.3 billion rands against a market value of 2.1 billion rands as of December 2022. The ROI on the original investment has improved to 12.4% from 11% in 2021 based on associate income. ETI continues to be a strong franchise, ranked in the top 3 banks across 14 African countries, number 1 in 7 countries, and number 2 in 3 countries, and number 3 in 4 countries. And ETI's return on tangible equity increased to 21% from 17.9%, with the 3 core regions achieving ROEs above 23%. If we now turn to the outlook for the Africa region's business, in 2023, we will continue to build on the improved performance of SADC and, as a shareholder, drive the value unlock agenda relating to ETI. In the SADC operations, our key focus areas will remain transforming the business and operating model in line with achieving scale, better efficiencies and market share growth, acceleration of our Pan-African digital growth strategy, continuing to unlock further value in Mozambique, and we will also amplify the focus on improving our quality of earnings from both SADC and ETI, while continuing to work together with the other shareholders to unlock value. In the medium to long term, we will remain focused on achieving our ambition of consistently generating returns that are above cost of equity and cost to income ratio of below 60%, and unlocking value to achieve ROI of greater than 20% relating to our associate investment in ETI. Thank you, and back to you, Mike.
Thank you. In closing, I will provide our current macroeconomic outlook and, in the context of this and delivery of our strategy, provide our usual short-term guidance for 2023. I will also share our new medium-term or 2025 targets and long-term targets. Starting then with our current macroeconomic outlook that informs our guidance and targets. In a world with so much volatility, both globally and here in South Africa, it is important to note that these forecasts do have more risk than would usually be the case, and we will review them again at interims like we usually do. Our group economic units forecast reflect that our forecast for the 2023 GDP growth has reduced from 1.8% a year ago to 0.7%, largely as a result of the negative impact of unreliable electricity supply. And thereafter, GDP growth is expected to remain muted at around 1.5%. Global inflationary pressures appear to be easing slowly, and we expect inflation in South Africa to return to within the SARB's target band of 3 to 6% during 2023. After the 25 basis point increase in January and a likely further 25 basis point increase in March, we expect the prime interest rate to remain flat from here at around about 11% and then to start a slow decline in 2024. Industry-level credit growth is expected to slow to around 5% in 2023 and remain around 5 to 6% thereafter. While South Africa's fiscal position is currently better than previously expected, debt to GDP still remains elevated, and the February 2023 national budget has execution risk on both the revenue and cost front. Using our economic outlook as a base and ongoing delivery of our strategy as an input, This slide shows our usual format of shorter-term guidance for the full year 2023. Net interest income, or NII growth, is expected to accelerate into 2023 as we see the full run rate benefit of higher interest rates through endowment income and margin expansion, while credit growth is expected to remain at similar levels to 2022. Our credit loss ratio, which was 89 basis points in 2022, is expected to remain in the top half of our through-the-cycle target range into 2023. That is somewhere between 80 and 100 basis points, as we continue to actively manage our portfolio through what is a difficult environment for our clients of higher electricity outages, higher interest rates, and higher inflation. Non-interest revenue growth is expected to increase by mid-single digits, driven by ongoing solid commission and fees growth and an improvement in trading revenues. Expenses, as always, will remain tightly under control, but are expected to grow by mid to upper single digits, primarily as a result of the introduction of new regulatory costs, such as the Twin Peaks levy, higher incentive costs aligned to our expected financial performance, all partially offset by ongoing cost optimization. Our average salary increase has been settled at around 6%, with bargaining unit staff receiving 7% and management around 5%, in line with our ongoing and conscious decision to give higher increases to those who need them the most. Minorities and associates are expected to grow more strongly in 2023 on the back of AT1 issuances and higher JIBAR-related pricing on these instruments, given the higher interest rate cycle. Capital levels, including the impact of our optimization initiatives that we announced today, are expected to remain strong and above the top end of our board-approved target range, and dividend declarations at the lower end of our target range of 1.75 to 2.25 times cover, subject, of course, to board approval at each reporting period. Given the strong performance in 2022, we have already achieved our 2023 DHEPS target of above 25.65 rand, as well as our NPS target of being ranked number 1 amongst SA banks. Achieving our end-of-year 2023 ROE target of above 15% and a cost-to-income ratio target of less than 54% remain a key focus of the management team. Looking beyond 2023, we have set ourselves new medium-term and long-term targets that, when achieved, we believe will support ongoing shareholder value creation. The medium-term targets, set now for the end of 2025, include compound annual growth in DHEPS from that 2022 base of more than nominal GDP plus 5%, an ROE of more than 17%, or around cost of equity plus 2%, and a cost-to-income ratio of less than 52%. Simultaneously, we aim to retain our number 1 Net Promoter Score rankings. The financial corporate performance targets in our long-term incentive schemes will be aligned to delivering on these medium-term targets for DHEPS, ROE, and cost-to-income, alongside other strategic and ESG-related targets. Our long-term targets are to sustain average DHEPS growth above nominal GDP plus 5%, an ROE of greater than 18%, or around cost of equity plus 3%, and to achieve a cost-to-income ratio of less than 50%. So in closing, despite the challenges in the environment around us, we are starting 2023 with a fortress balance sheet and are progressing well on our strategic delivery, with tangible proof points on how we deliver value, whether it is in our technology IT build, digital growth, client satisfaction metrics, cost optimization, cross-sell metrics, targeted market share gains, and active capital management, or through us making a purposeful impact in the countries and the communities where we operate. We have good momentum towards our 2023 targets, with our DHEPS and Net Promoter Score targets already achieved, and we are on our way to meeting our ROE and cost-to-income targets, as well as retaining our Net Promoter Score position. In conclusion, in this complex and volatile world, our focus at Nedbank will remain on what we can control and delivering on targets that create shareholder value in the short, medium, and long term. Thank you, and we will now proceed to Q&A.